when you look from a demand perspective, we believe from our proprietary road model, we believe that we are almost a decade away from a peak in oil demand. So that's likely by 2034. This is more further out compared to our prior imagination, and this is more bullish than other forecasters, for example, IEA. Again, from an oil demand perspective, it's not just that the peak will happen 10 years later, but after the peak for another 10 years, we believe oil demand will then plateau rather than decline. So in that context, we think the implications are more constrained supply-demand environment for oil value chain. And what does it mean for investors? To your question, we believe free cash flow, access to growth projects, and existing profitable projects will be the key words in the upstream sector. When you go to the downstream, for example, refining, we believe we're not building enough refineries in the world for the next few years. In fact, we are closing capacities. It's been a common trend in developed markets in China. So we also like companies exposed to refining theme, especially the diesel market.
So, Nikhil, just to sort of translate, right, and make sure I've got my head around this, right, you're saying upstream for the producers, right, the explorers, et cetera, capacity and size matters, and it is cheaper to buy than to build it.
Yeah, sure. The oil assets take very long term to build, right? We think the companies who have a higher inventories of oil or reserves of oil will be attractive as an investment opportunity, whether companies are looking to buy them or whether investors are looking to invest in those companies. So companies who are already sitting with high inventory of oil, and given we have peak oil demand another decade away, will be in the limelight.